Good evening. You're tuned into Business Day right here on ET Now with me, Avan Dabash. Let's take a look as to how the markets shut shop this Wednesday before we take you through the top headlines. Well, it got off to a good start, but we didn't manage to hold on to those gains, and by the end of the day, it was a very tepid close for the frontline indices. The market breadth too was just about even Steven, and it was close to 1 lakh crore rupees in terms of the total turnover. Cement stocks once again surprised on the upside, and by the day's close, the Nifty was at 59.59. The Sensex didn't even manage to hold on to its gains, shutting shop lower by 20 points at 19,639. Lots of big stories, including corporate earnings. We'll get you all of that and lots more after the top headlines. The Finance Ministry shoots down the IRDA Chairman J. Hari Narayan's demand to move LIC out of the insurance regulator's purview, justifying the higher investment cap for LIC. Top Finance Ministry officials tell ET Now that it will only boost LIC's investment portfolio. Vodafone faces yet another volley from the taxman, even as it works overtime to sort out things over the $2 billion capital gains tax demand and a mega transfer pricing case. The IT department fires a fresh salvo alleging underpricing of 1,300 crore rupees worth of shares. Your pension money may soon find its way into mutual funds. AMFI draws up a plan to channelize pension funds to mutual funds, and the Finance Ministry will now take a final call. The central bank moves to curb demand for gold as high imports throw the government's finances out of gear. The RBI says it is keeping a close watch on gold loan companies as their weak capital adequacy ratio is a matter of concern. A breather for infrastructure companies. The National Highways Authority plans to relax norms for road projects after GMR pulled out of the Kishangar-Ahmedabad project, coupled with easier environment clearances. NHAI hopes to rope in big infra players for road projects. Okay, let's take it straight to action on Dalal Street, and as pointed out, it was a very lackluster session for the equity frontliners, and the Nifty was just above that 59.50 mark at 59.59 by the day's close. In terms of the broader markets, you could say that it was a comparatively better show. So you have the mid-cap and the small-cap index which eked out marginal gains. In terms of sectoral indices, well, it was real estate which powered ahead. Technology as a pack also looked very robust. But on the downside, quite a few frontline cap goods names as well as power stocks, they came off by the day's close. Some of the top gainers then in today's session. JSPL did well for itself, Kotak Mahindra, and as pointed out, it was cement which really flared up today. So a day ahead of its numbers, Ambuja Cements looked healthy, higher by 2%. Ultratech Cement too was higher at 1962. Some results that were declared today, Apollo Tyres put out its numbers. You had the net profits which were higher by 84% at 181 crore rupees. This was below what the street was expecting, but nonetheless a fairly decent set of numbers. The Q3 top line growth was down by 0.3% to 3,217 crores, and EBITDA margins expanded to 11.8% versus 10%. There was a Q3 other income of 26.7 crores versus a loss of 2.4 crores on a year-on-year basis. The counter was down marginally in the red. Moving on then to the infrastructure space, IRB Infra delivered a great set of numbers. The profits were up by 8.8% at 143 crores, and the top line growth was higher by 22.5% at 914 crores vis-a-vis 764 in the last quarter. EBITDA margins looked strong as well. 44.6% versus 45.8%, the street clearly giving it a thumbs up. Jindal SAW also delivered a good set of numbers. Their profits for the third quarter were higher by 64% at 60 crore rupees. The top line growth also came in higher by almost 60% to 1,720 crore rupees. A great show from Bajaj Electricals, and you have the stock price which also gave it a resounding thumbs up, higher by 6.5%. You have the profits which came in low by 64% at 11 crores. Top line growth was higher by 10% at 872 crores versus 793. Some stocks in focus from the ADAG pack. Reliance Communications was up as the Kolkata High Court granted it a stay till the 28th of February on the one-time fee. Remember, the Department of Telecommunications had asked the company to pay 170 crores as a one-time charge. Adani Enterprises got a good response to its offer for sale, which was fully subscribed. The indicative price is close to 250.8 per share. Remember, 70 lakh shares were offered in the offer for sale. Panacea Biotech got a good leg up as it will be getting 750 crore rupees from a realty project with Bestech Group. And remember, its top line in FY12 stood at 700 crore rupees. The sugar pack really sweetened in today's session the likes of Sri Renuka Sugars, Bajaj Hindustan as well as Balrampur Chini as the Food Ministry seeks the cabinet approval for sugar decontrol. Simbali Sugar also did well. Remember, it's mulling equity share raising on a preferential basis on the 12th of this month. Thomas Cook, there was the news that it bought 74% in IKEA Human Solutions for a sum of 256 crores. Some of the big losers then today, as pointed out, it was Cap Goods which fell flat on its face, Jayaprakash Associates down and out, NTPC as well as L&T was a big laggard. Not just that, you had Coal India which ended the day lower by 2%. But on that note, let's get in some market perspective from prominent market voices who joined in earlier on the show. Well, we spoke with Sandeep Bhatia, who in fact believed that there will be a decent and responsible budget to which we can see a run-up in the equity markets.
I think, everything should not look good all the time. That's what makes the market trade up and down. So what do we say? I think the big fundamental trigger is the budget. I think we will see sector rotation. I think we will definitely see some amount of profit taking in consumption stocks.
We've been saying that the markets have had two legs since the last 6 months. The first leg has been the hope trade from the government, and second trade has been a favorable global backdrop. Both these legs are playing out, but one must remember that India, while it is a beta trade, the issue arises when crude prices go beyond acceptable levels. So our current account deficit is something we've been highlighting as a weak point for the markets for quite some time now.
Okay, that's some market opinion coming in, but a fairly lackluster day all in all for the frontline indices, which were the active calls and puts. And how did the Nifty futures shape up? Let's get in Navneet Saluja, who joins in from our research team. Hi, Navneet.
Hi, Awan. It was an extremely volatile and a lackluster day. You saw the Nifty opening at least 30 points up, but we closed almost flat. And that's the pressure which is coming in because the domestic institutions have been continuously selling in this market. And we'll see the figure today also. Well, if you look at the Nifty February futures, they closed down at 59.71 with about 12 points premium to the spot Nifty. And during the day, the futures added over 10 lakh shares. And if you look at the options data, well, the Nifty PCR continues to remain below that crucial level of fun. In fact, today it declined to 0.93 versus the previous closing of about 0.96. The most active call strikes during the day were 6,000 and 6,100, whereas the put strikes were 5,900 and 6,000. There was more of call writing seen in today's trading session. So you had 6,100 and 6,200 strikes, which added about 8 lakh shares. On the put side, you had 5,700, which added the maximum 7 lakh shares, followed by 5,800 and 5,900 put strikes, which added over 3 lakh shares. Shifting focus to some of the stock futures which were active today. Among the Nifty gainers, you had some of the banking counters like Kotak Mahindra Bank and Bank of Baroda, which did well. Long positions were seen on the future side. Well, the cement space was active again today. So you had Ultratech and Ambuja, where fresh longs were being built up ahead of the numbers. Remember, ACC and Ambuja would be declaring their quarterly numbers tomorrow. On the short side, you had JP Associates, NTPC and L&T, which were down. And from the mid-cap space, you had SAIL and Allahabad Bank, which were down and about. So short positions seen there. On the long side, you saw a good recovery coming in for Jubilant Foodwork. That counter was up by 8%. Also, Renuka and IRB Infra were up. Long positions seen for all these three counters. Well, looking at the participation, the volume was also very thin. If you look at the turnover, we did only about 72,000 crore of turnover on NSE by the end of the day.
Okay, thanks very much, Navneet, for giving us that detailed perspective in the F&O space. It was the Asian markets, though, which really caught everyone's attention today as they rallied across the board. Particularly, it was the Nikkei which hit a 4-year high following a sharp fall in yen. Remember, the Bank of Japan governor's early departure has fueled expectations of an aggressive monetary easing to boost the flagging economy. So you had the Nikkei which shut sharp at 11,463, crossing some psychological levels on the upside. Let's take it straight to Kathy Yang, who now joins in from Reuters in Hong Kong to find out what the investment managers are saying about today's rally. Kathy.
It's stunning when you look at the Nikkei 225 index and see how it's just charted its way up since the yen's weakened further soon after the new administration under Abe took office. But the improved risk appetite is spilling over into the rest of Asia as well. Stocks here in mainland China, for instance, hovering at its highest since May 2012. Shanghai stretching its winning streak into an 8th day. And a lot are now questioning the durability of this rally we're seeing across Asia. And the rallies are coming at a time. Economic data from China to the U.S. are showing signs of a recovery. And the earnings of Asian companies are improving. So I asked Bill Maldonado, he's the global CIO of HSBC, what he thought. And he told me that stocks across the region are not even back at fair value yet, and that there's a long way to go. To get stocks back to fair value across Asia, Bill says they'd have to go up another 20%. It's just that investors are still cautious at this stage, and it's going to take some time for them to feel more confident about taking on more risk.
Thanks very much, Kathy, for giving us that perspective. Moving on then, back to our own markets and on corporate news back home. A day after insurance regulator J. Hari Narayan dared the Finance Ministry to take LIC out of the regulator's purview, Finance Ministry officials say it is an unreasonable demand. Mrinalini Krishna now joins in with the details. Mrinalini, a very sharp retort. What are the details that you have regarding the same?
Well, it's definitely a sharp retort. What we are picking up from Finance Ministry sources is that IRDA's demand of keeping LIC out of its purview is not reasonable. In fact, they went on to say that the current structure of IRDA being the regulator regulating LIC is something that can be changed only by the Parliament because it's enshrined in an act. Going on with the rationale of hiking LIC's investments limit to 25% in listed stock and 30% in unlisted stocks, Finance Ministry sources say that LIC was already exceeding that cap in many cases, which is why it had to be brought up. Apart from that, a low investment cap would mean that LIC, that is sitting on a huge amount of cash, would have to then invest in poor quality stocks, and there would be poor stock selection because it could then not invest in good quality stocks where it would have already exhausted its limits. Coming back to the fact that the investment limit was hiked, and the point that Hari Narayan had mentioned that LIC should not be treated differently from private insurers, Finance Ministry sources say that there is a huge amount of difference in the assets under management and the investments of private insurers and LIC, and which is why it is not fair to treat them at par. There may be a way going forward where there is an asset under management based investment cap that could be considered, but for the time being, the Finance Ministry is sticking to its stance of raising the LIC's investment limit and definitely not very happy with Hari Narayan's views.
Thanks very much, Mrinalini, for bringing us all of those exclusive details. While the centre mulls over a settlement talks with British telecom giant Vodafone, the taxman seems to be singing a different tune. ET now learns that after being slapped with an 8,500 crore rupee transfer pricing order, which remains unresolved, in a fresh setback for the telco, revenue authorities have now alleged an underpricing of 13,000 crore rupees by its Indian arm in a recent transfer pricing order. Ashwin Mohan now joins in for the latest details. Ashwin, Vodafone's India woes seem to be just piling on.
Well, one can't help but remember Vodafone's earlier jingle, wherever you go, the network follows, because this time around it looks like wherever Vodafone is going, the taxman is following it. Clearly, the British telecom giant seems to be facing fresh tax woes in India. On one hand, there is no uncertainty as regards the settlement talks regarding its 14,000 crore tax case over the 2007 Hutch deal. On the other hand, we also have the same company facing an 8,500 crore transfer pricing order that was issued last year that is still being fought out at the Bombay High Court. It is yet to be resolved. And what we now pick up from sources is that in the latest setback, the latest tax setback for the British telco, we understand that there's been a fresh transfer pricing order that has been issued against the Indian arm of Vodafone that has alleged underpricing of nearly 1,300 crore rupees by the Indian arm. Now, this entire order relates to the issue of shares by the Indian arm of Vodafone to its overseas group entity based out of Mauritius. That's Vodafone Teleservices Mauritius. According to the Income Tax Department, Vodafone had valued the issue of shares at 8,000 rupees per share, but the Income Tax Department believes that the value in fact should have been 50,000 rupees per share. So therefore, the Income Tax Department has challenged the valuation methodology used by Vodafone. The same principle that was used in the case of Shell earlier, the same principle has been applied in the case of Vodafone as well. When contacted, a Vodafone spokesperson told ET Now that they refute the order and that they will study it and take appropriate action in due course of time. But clearly, this seems like yet another blow for the British telecom giant. Its tax foes seem to be piling up one after the other in India.
Piling up they do, so taxing times clearly for Vodafone. Thanks very much, Ashwin, for those details. Moving on into the mutual fund space, and your pension money may soon find its way to mutual funds after the Finance Ministry's directive to channelize pension money into the same. The mutual fund industry body, that's AMFI, has designed a pension scheme for mutual funds. It has submitted this plan to the Finance Ministry, which will take a final call on the matter. Mrinalini Krishna is here with a report.
You may soon be able to plan your retirement corpus through a mutual fund. Mutual fund industry body AMFI has submitted a pension plan design to the Finance Ministry after North Block directed the industry to channelize pension money into mutual funds. Sources say the plan could have an age-linked equity exposure, which will depend on the investor's age. So after an investor reaches 55 years, the equity exposure will come down to 50%. At 60, it will taper to 30%. And by 70, the investor cannot have any exposure to equity. In fact, to make pension plan mutual funds more attractive, the industry body has also sought tax benefits to bring the product at par with other tax savings instruments like the NPS and insurance pension schemes. Experts say this move could change the saving pattern of an average Indian household.
If it becomes a reality, if it happens, then this will be revolutionary, because this will facilitate a mechanism where there will be consistent money flowing into the market. The money which comes in will not exit in a hurry, and so this will be great.
To ensure that the funds are safe, AMFI has proposed stringent eligibility criteria for funds as well. Only equity diversified funds, not sectoral or thematic funds, will be eligible for this plan. Also, every fund offering this plan must have a 3-year track record along with a minimum AUM of 300 crores for a period of 3 years. Experts believe a plan like this will bring in big money to the equity markets and improve the depth of Indian capital markets.
About 30-35 years ago, American equity market gained the depth when the 401k plan was introduced there. This is the equivalent of a 401k plan where investors have the choice.
Finance Ministry clearly wants more long-term savings into the markets from retail investors. Another way of bringing retail investors who've shunned capital markets back to the street. And this just may be one of the ways it hopes to do so. All eyes are now on the union budget, where an announcement for pension plans for mutual funds may be made. Mrinalini Krishna, ET Now, New Delhi.
And the Reserve Bank of India has released the final report of the working group on gold imports and gold loan NBFCs in India. The report says there is a need to moderate the demand for gold as well as manage the supply of gold and gold-related investment products, as rising gold imports have been the main reason behind the widening current account deficit. Anirudh Ghosh now joins in with the details. Anirudh.
Well, yes, the first thing to note here is that this is the final report of the working group set up by the RBI to examine the issues relating to gold demand and gold loan NBFCs. And of course, they've come up with a whole host of recommendations. They can actually be broken into two big headings. One, of course, is the macro situation, where they're talking about curbing gold demand. They're talking about various things that can be brought about to ensure that the huge demand for gold in the country that, of course, is leading to the widening of the current account deficit could be put an end to. Of course, they've suggested various things like setting up a gold bank to monetize the idle gold resources in the country. They've also mooted setting up instruments that could actually provide a real rate of interest, like, for example, inflation indexed bonds and a number of other things like gold-related fixed deposits, gold-related mutual funds as well. So clearly that's one aspect which the RBI wants to focus on. On the other hand, the more pertaining thing as far as gold loan NBFCs are concerned is the fact that the report has really taken a view that these gold loan NBFCs do play a very vital role in the economy, but at the same time their unbridled growth is something that needs to be taken care of. They need to really tackle the fact that there's been a huge amount of growth in terms of these gold loan NBFCs as far as their branch expansion is concerned, and also as far as their asset base is concerned. So these recommendations really say that the RBI must take a very strict view as far as these gold loan NBFCs are concerned. They should take a relook as far as the regulations are concerned. They're asking for more capital requirement as far as these gold loan NBFCs are concerned. They also want that their funding is regulated.
Thanks Thanks very much, Anirudh, for bringing us those details. Well, those are the latest details coming out with respect to the NTPC offer for sale floor price. And as we understand, it has been set at 145 rupees per share. Now, remember, this was the indicative price band which was floating around close to 145 to 150 rupees per share. The government is going to be selling 783 million shares, and therefore they will bring down their stake to 75% and raising close to $2.1 billion if the floor price were to be at 145 per share as per CLSA's estimate. Remember, most of the analysts had estimated that at a price of around 145, it did look fairly attractive and that one could subscribe to the same. Remember, the stake sale will be commencing just tomorrow and it will be closing at 3:30 after opening at 9:15. You had the divestment department, which recently also completed that 10% stake in Oil India via the auction route, and that time they had raised close to 3,141 crore rupees. Of course, this is also going to rake in quite a bit of money to the exchequer, but let's just get in some expert opinion on the same, and we do have with us Bhavika Thakkarpa, analyst at IIFL. Bhavika, your first reaction, the offer for sale price has been set at 145 rupees per share.
Yeah, we also expected that it would be set around 145 only, because we have seen in Oil India, the normally price discount is around 5%, and the stock has already corrected to 151 today. So the 145 is the price what we are also estimated that it would be a floor price for NTPC divestment.
So, Bhavika, with respect to this, do you think that right now this would be attractive and that you would advise investors to go for the same? Are you convinced that with respect to the performance matrix also of NTPC that is likely to change?
Yeah, it's a good offer at 145. Because if you look at because of this offer for sale, the company's the stock price did not perform well. It's been hammered down from 165 or to 151 now. And if you look at the valuation perspective, it's currently trading at around 1.5 forward book value of FY13. So the NTPC normally trades at around 2.2x, and we have a good target of around 187. Obviously, it's a long-term target. But looking at this price, 145, it would be attractive, and I think also it will get oversubscribed.
You believe that it will be oversubscribed? Yeah. And with respect to talking about certain fundamentals of NTPC, you do have some of the concerns with respect to the growth rate and the fuel concerns. How do you see those fundamentals shaping up, and do you think that those will be lingering worries?
For NTPC, I don't think it would be so much of an issue, because as you know, even coal polling has been approved. Definitely it's an in-principle approval. It will increase the cost of unit generation, but it would be for overall, not just for NTPC. And reforms are taking place, and for the fuel security thing, I don't think it's quite safe to invest in NTPC compared to other IPPs. And if you look at the execution part, NTPC has been doing good till now in FY13, they have a robust investment proposal in hand. And I think it's a good price to invest, and fundamentally also it's good buy.
Thanks very much, Bhavika, for joining in with your opinion. Dipan Mehta, member BSC and NSE, also joins in. Dipan, thanks for being with us. The floor price has been set at 145 rupees per share. What do you make of it?
I think it's in line with what other divestments have taken place in terms of discount, and I think the government has been very pragmatic with its disinvestment program this time around in terms of giving, which is why it has received fabulous support from FIIs as well as local investors. So broadly, I think it is a step in the right direction, and I think that the issue per se will be a huge success.
Okay, thanks very much then, Dipan, for joining in and giving us your view. So most of the analysts believe that this is what we were expecting, and there will be an overwhelming response to the same. Remember, it's at a 4.5 discount versus the last traded price, and the government will be divesting a 9.5% stake in the same. But with that, we're completely timed out right here on Business Day. Thanks so much for watching. Stay tuned to ET Now.